Well, good noon, everyone here in London, as we say, and welcome to our FS Club webinar today. And it's a real delight for me to be opening this session because this might be the last Brexit session before Brexit really is Brexit. We're looking ahead to 2021, moving beyond Brexit in financial services regulation. Now, you'll know me, I'm Michael Mainelli, I'm one of the directors of Zien. And it really is my privilege to be able to introduce these webinar series, principally because our sponsors are so kind and generous, allow us to range widely and freely across technology, economics, and finance. But today we're doing so with particular focus on one of our knowledge hubs, the ESOP Center, all dedicated to employee share ownership. And we have today two guests, both from Baker McKenzie, Jeremy Edwards and Mark Simpson. The format today is fairly straightforward. For those of you who've been here before, you'll know I try and get out of the way as quickly as I can so you can hear from our experts. They will talk for about 20 to 25 minutes, and we are going to have approximately 15 to 20 minutes for questions and answer. And do look forward to a vibrant discussion. To do so, however, please do use the GoToWebinar question facility. I am here with you. And so emails to me and text to me. I'm very sweet, but I'll be reading them afterwards. So if you want to participate in the conversation, send through using the Q&A facility to me, and I will feed them in to a conversation with Jeremy and Mark. Just before, in the kind of classic radio talk show host sense, you know, a word from our sponsors, but fortunately I can show you a picture of our sponsors. As you'll see, all of our sponsors have an intense interest in today's topic, which is very much Brexit and financial services. And those in the ESOP Center group are particularly interested in today because one of the untold things about Brexit, or one of the many overlooked things perhaps more accurately, is that Brexit has some very serious implications for the way in which we might be looking at employee share ownership going forward. And meanwhile, at the same time, on the continent, there are renewed interests in looking at employee share ownership as a way forward, so that we can see some changes ahead. Anyway, enough from me. Let's hear it from our experts today, and I'm delighted to ask Jeremy to kick things off. Jeremy, the floor is yours.
Well, thank you, Michael, and thank you for allowing us to speak today. So today, as Michael said, we're going to look ahead at the implications of Brexit in financial services regulation in 2021 and beyond. So Michael, if you just go to the agenda page. When we first set up this webinar for mid-December, I was envisaging, well, I wouldn't say hoping, but I was envisaging that there would be more certainty in terms of the overall deal agreement with the EU. Well, alas, that's not to be as yet. But this is a useful opportunity to focus on what we do know at the moment. And actually, the financial services regulation, especially in the remuneration field, is quite well set. And so we'll be able to explain where we've got to up there. There are wider uncertainties at the moment, including in particular the uncertainty and changes that are being caused by the COVID crisis, which is another key feature of our current times. And I'm going to look briefly at the wider implications of this in the context of Brexit. So we'll start today with Mark giving us a Brexit overview in terms of the financial services regulation, looking at policy, and then I'll come in and look at a little bit more remuneration angles, and then look at more COVID, and I'll even talk a little bit about CGT as well, and that dreadful CGT announcement by the OTS. So we'll pack everything in today. So over to you, Mark.
Thanks very much, Jeremy and Michael, and very nice to be here, everybody. So, yeah, I think it falls to me to give a general overview on where things stand with Brexit and financial services. And in the first place, so I will talk a bit about where things stand. Then I will move on to discuss some of the policy initiatives that will we think might result from Brexit in both the EU and the UK, with a particular focus on retail investment share schemes. We'll also talk a little bit about the remuneration rules, as Jeremy mentioned, so both from a UK and an EU perspective, and where we might see some divergence going forward. So to start with the state of play, so at present, as you mentioned, Jeremy, the UK is in the final stages of its transition period, as we know, with the EU. We still don't have that elusive trade deal. Time is running pretty short. Realistically, it needs to be wrapped up in the next couple of weeks for the end of the year. We don't know yet exactly what the shape of that FTA will look like, though we have some idea, but it's safe to assume, I think, that it's going to be pretty thin when it comes to financial services. Both the EU's and UK's draft negotiating text were sort of relatively unambitious when you compare it to the current market access that the UK has to the EU and vice versa. So it appears likely that the future relationship between the UK and the EU in financial services will be founded on the concept of equivalence, already found in EU law, now onshored into UK law, by which the EU and UK can unilaterally declare the other side to be equivalent across a range of areas. I think it's fair to say the UK and EU have a fairly different starting point when they think about what should underpin equivalence. So for the EU, it's a political process really that is part of the EU's policy toolkit, and granting or withdrawing equivalence can be used as leverage by them in other areas of the negotiations, as we've seen with the UK-EU FTA negotiations and previously with the EU's relationship with Switzerland, where equivalence was withdrawn from Switzerland a year or so ago now. So this enables the EU to insist really that in order to be equivalent, a system needs to be very similar to the EU one. And as part of that, the EU will consider the level playing field type issues, which is relevant to how UK rules might develop post-Brexit, because if the UK decides to exercise its rights to diverge from EU law, then it may have an impact on the UK's continuing ability to be deemed equivalent in the event that it is to start off with. So we haven't yet seen very many equivalence decisions from the EU. We have, though, seen a host of UK unilateral decisions taken last month. So that has been helpful in terms of providing some much needed clarity to the market in London around its ongoing ability to use EU trading venues and to have EU benchmarks recognised, for example, in relation to the trading of financial instruments that reference those benchmarks by UK firms. So that's quite helpful. As I said, we've not really seen much back from the EU, so it may be we see something in the coming week or two, or it may be that nothing is in place come January the 1st. And our general sense is that the industry has planned extensively for this. The financial services sector has, for the last 3 or 4 years, already been implementing contingency plans around transferring business and customers to EU subsidiaries ready to trade on the 1st of January. That obviously has costs and inefficiencies to it, but there's no real alternative for firms at the moment, other than assuming a worst case, no equivalent outcome. As I said, the UK has taken a bunch of decisions. It's also set out in principle how it intends to use its equivalence framework going forward. So it has said that it wants to maintain an open system where it judges equivalence of other countries on outcomes underpinned by compliance with internationally agreed standards, that it should be a transparent of granting or withdrawing these decisions, and it should be a stable and reliable set of arrangements to ensure continuity and cooperative between the two jurisdictions, both when established and afterwards. So that's all sort of reasonably positive from the UK, but as I say, we need some reciprocity from the EU. The other point I'll just mention is that the UK authorities have also been legislating domestically to mitigate the effects of the cliff edge on the 1st of January. So one of the limbs of that is a temporary permissions regime, which basically allows EU firms to continue providing services inbound into the UK for a period of up to 3 years, subject to then obtaining full UK regulatory authorization from 1st of January. So that's helpful. A lot of firms, I think over 1,000 firms, have entered into that regime. And alongside that, the Parliament has also created a temporary transitional power, which basically allows the regulators to waive certain rules that will come into effect after Brexit. So in those areas, firms will be able to carry on complying with the old rules they were subject to under the EU regime rather than the new rules, again, for a temporary period. So this will effectively operate as a standstill for firms to mean they don't have to comply with a whole raft of new rules as from January the 1st. So that's sort of quite helpful. I think the UK has done all that it can do realistically on a unilateral basis to mitigate the effects of this. And now we wait to see whether there's any reciprocity from the EU side. That's where things are at in the negotiations. If we can just go back actually, possibly to the slide I think before this one. So the next topic I just wanted to touch on is, what do we see as the potential policy initiatives that may result from Brexit? And Brexit poses obviously a significant issue for the EU in terms of the departure of its largest financial centre, only true global financial centre, from the EU. We expect the EU over time to try to onshore quite a lot of business into the EU. We expect that they will not be happy with a long-term situation where the EU is reliant on, or over-reliant on, the City of London for capital raising and so on. So there's a sovereignty angle for the EU in terms of how it goes forward. One particular issue that the EU has long identified is they have a quite poor level really of share ownership, particularly in SMEs, compared with levels of share ownership in other markets like in the US. And so the EU has a project called the Capital Markets Union, which was, has predates Brexit, but Brexit has made it more important. And so the EU has acknowledged that it's trying to increase levels of retail equity ownership. And with policies like financial education and employee share ownership programs being recognised as effective tools in this regard, and also the EU has recognised that employee share ownership can be very helpful in increasing financial awareness and literacy. So we've seen with the CMU project, we've seen a Commission paper back in June this year, a report on completing the CMU, which recommended the use and promotion of employee share ownership as a way to encourage citizens' participation in capital markets, and recommended some specific actions around this. So one of those was that the Commission should, by 2022, explore which EU funds could be used to promote the use of employee share ownership across Europe, and also that member states should consider promoting ownership by providing tax incentives by 2024. And also the Commission should discuss in relevant expert groups to which extent member states are already promoting employee share ownership, and think about ways to increase the uptake by 2023. Subsequently, in September, back in September, the European Parliament issued a report to the Commission on the CMU, which called on the Commission to explore initiatives to incentivise employee share ownership in order to promote direct involvement of retail savers in financing the economy. And then again, and back in September, we had another communication from the Commission on the Capital Markets Union, which did not include specific actions around employee share ownership, but did deal with a number of general initiatives around retail investment, including calling for a new retail investment strategy, which the Commission is expected to present in the first half of 2022, focusing on things like how investors can benefit from adequate consumer protection, unbiased advice, how they make markets more open, and how consumers are to be provided with transparent and understandable product information. So a whole load of stuff there around trying to promote retail investment. Also, the Commission is going to look at the implications of the current MiFID inducements rules and whether those need to be changed to try to increase levels of accessibility for retail investors. So conscious of time, I'll just touch on a couple of other things on this slide. So the EU also has a initiative called Startup Nation. This is about trying to make the EU a more attractive destination for startup and scale-ups, including through investment into those entities. And one of the things they're looking at there is how you can make the granting of employee stock options more attractive in that area. And then the digital finance strategy I mentioned there, again, that's another limb which the EU is looking at, part of that, how they can improve investor information that's provided where consumers use digital financial services. ESG, that's an initiative at both UK, where I think there's a general sense that promoting ESG through in investing is going to increase the attractiveness of retail investment, particularly by younger people. So both the UK and EU are going to have their own frameworks around this that are going to be quite similar. The UK has also got its own initiatives, which I'll just touch on briefly. Open finance is a topic the FCA is consulting on, quite a big topic where they issued a call for evidence last year, and they're currently considering that. And then in terms of the future direction of travel around the UK framework, I think our expectation is that the UK is going to use its post-Brexit freedoms to try to do things a bit differently. So there's a financial services bill that's currently in Parliament, which is going to make some fundamental changes to the way that the UK regulates this area. The idea is it will become a higher level principles-based regime with fewer codified rules that has been very much a feature of the EU system. There's going to be some quite interesting provisions built into that around innovation. So the regulators will have to have regard to technological innovation when they regulate. That could include, for example, requiring them to have machine readable rule books to promote the use of AI. And more generally, just giving the regulators more power to regulate more quickly through rules rather than through laws, so that the UK can have a sort of more adaptive framework and focused. In terms of substance, the EU system has tended to focus a lot on things like disclosure, lots of rules around what you must tell investors. The FCA is more driven by behavioural economics, and in its view, a lot of that disclosure is not really used by investors very much, or does not really lead to a change in behaviour. So we think they're going to be more outcomes focused, probably fewer rules, and a bit less sort of a compliance burden on firms with all the disclosures that they've had to be making. And then in terms of style, we also expect them to be a bit more bottom up than top down driven. So very much looking to industry to help with developing their own codes of practice, which regulators could endorse, and sort of helping have that market led approach, which sort of goes back, I think, sort of probably 10 or 15 years to when we used to do a bit more of that. And again, that's probably a good thing. What I think it isn't is a race to the bottom. I'm pretty sure that, you know, the UK is going to maintain a very robust regulatory system. It will still have high standards and achieving, you know, outcomes through maybe a different route. But again, you know, no real sense there of a sort of decline in standards. And in terms of areas they're focused on, apart from green finance, which I mentioned, also they're going to look at the listings regime, how that could be reformed to make things more, to make London more competitive, and also a big focus on fintech. And then, so just moving on to I'll just very briefly touch on these next couple of slides to segue into Jeremy's section. I mentioned that there's going to be some reforms in relation to the remuneration rules, which I'm sure some of you are aware of. So just to briefly touch on the EU regime under the Investment Firms Regulation and Investment Firms Directive, which will apply from June of next year. Those are going to do a few things in terms of reclassifying investment firms into different classes, changing how they calculate their capital requirements as well, but also introducing a new set of remuneration and governance rules, which will be similar but not identical to the CRD regime Jeremy is going to come on to talk about. I'll just sort of briefly touch on the remuneration aspect of this. Broadly speaking, it's going to make a lot more firms subject to these payout process rules, so-called, around which require, you know, typically at least 50% of variable pay to be paid out in so more firms are going to come within the scope of those rules. More employees are going to come within the scope of those rules as well. In the UK, generally speaking, the exemption for employees who can be outside the scope of those rules is going to be lowered. The UK old exemption was £500,000 variable remuneration. The new one is €50,000 variable remuneration. So there's quite a big drop in the threshold within which you can be exempted from those rules. So more firms, more individuals caught by these rules, likely to mean more people being paid out in shares than in the past. And if we can just move on to the next slide, where or maybe actually the slide, yeah, this one, that's the right one. So I mentioned the UK is going to have its own regime. So the IFR and IFD were not part of the in-flight legislation that the UK is onshoring, so will not be implemented in UK law, but the UK is going to have its own investment firms prudential regime, which ticks on a number of the same issues of IFR and IFD. It's going to be very similar to the IFR IFD in terms of the overall outcomes, but the one point I would just flag there is that the last one there on the bottom right, that we need a more outcomes-based approach. So whereas the EU is going to have a more prescriptive, rules-based set of standards under the RTS that will be issued under IFR and IFD, the FCA is already indicating that it's probably going to take a sort of higher level approach to this. There's going to be a consultation in Q2, I believe, on that from the FCA. So that was all I was going to say. And Jeremy, I will hand over to you now to continue on this topic.
So, Michael, can you move to the next slide, please? Yeah, so I really want just to recap at this point of the key areas that I'm going to talk on today on financial services remuneration. I'll be looking at Capital Requirements Directive 5, i.e. CRD 5, as one of the key areas. I'll also be looking, but I want to look more broadly at issues in relation to Brexit. And it's really quite interesting hearing from Mark a minute ago, where the EU has a lot of these initiatives to encourage share ownership, whereas we suddenly get a recommendation to the government made by the Office of Tax Simplification to raise rates of capital gains tax. So I want to think about Brexit in where we might be going in a broader sense, and also looking at the impact of COVID and in the context of Brexit as well. So let's just move to the next slide. I think I just want to look really sort of high level, really. So in terms of CRD 5, I think the message that I would give is don't expect radical changes in the direction in the regulation of CRD or CRR pay. The UK is committed to implementing CRD 5 before Brexit, so I think it's coming through on the 28th of December, our implementation. And then to that end, the PRA and FCA have been publishing policy statements, and actually the latest one confirming the position was actually published just last week on the 9th of December. And actually, if we go to the next slide, and the main message I want to give here is actually don't expect a radical change in direction from the UK regulators. The UK regulators are fully aligned with the EU in their approach to wanting to make sure that remuneration policies are consistent with and promote sound risk management. And all these statements that were made after 2008 are effectively in place. And I would say that the UK regulators have got no desire to undermine at the moment the high standards that they're taking. And indeed, actually, if you look at the implementation statements, the PRA makes it clear that they expect all firms in the context of CRD 5 to continue to make every effort to comply with all aspects of the EBA's 2015 guidelines and all existing domestic requirements. Where we might see some changes at the edge is in relation to particular clarifications on very specific remuneration issues. But don't expect the regulators to want to sort of end up in conflict in interpretation with how the EU might be implementing remuneration requirements for CRD 5. It's very much at the very edge as to how the UK would approach a particular remuneration issue that comes up, maybe clawback or something like that. Don't expect a radical change of departure. So in the context of CRD 5, if any Brexiteers were hoping that all the bonus caps were going to go, well, you're not going to get there. They're going to remain in place in the UK. I'm not going to talk very much about key changes of CRD 5 because actually it's quite a well-worn route map. What I will say is when I looked at the latest PRA announcements, they do respond to points in the consultation, but actually in measurement of a fairly cautious response. You can see that they don't take into account everyone's comments. They go, well, it's sort of like you go, well, we acknowledge this point, but you know, we're just going to carry on as we previously wanted to implement. So a fairly cautious regulator at the moment, and one that doesn't want to make remuneration an area that undermines sound risk management. It's a key theme of the PRA and the FCA. As I said before, I'm not going to really speak very much about CRD5, but for obviously that affects UK banks, building societies, and PRA designated investment firms. I mean, key changes that are coming in for affected firms include a significant narrowing of the de minimis material risk taker carve out, which is now restricted to those MRTs with variable remuneration that doesn't exceed 50,000 euros and not more than a third of total annual income, which is considerably less than the current threshold of 500,000 euros. In fact, the bonus cap is no longer going to be disapplied on proportionality grounds, which will affect level 3 firms in the UK. And the minimum vesting period for material risk takers is going to be increased from 3 to 4 years, and for senior management to be kept at a minimum of 5 to 7 years. Clearly, some firms are going to be taken out of the CRD5 ambit and put more in the investment fund ambit. But as you can see, the rules are all based on the same principle. So I think what it amounts to is don't expect radical changes at this point. So next slide, please. So that gives me a little bit of time, really, just to talk about remuneration and Brexit in general. Obviously, the overall trade agreement with the EU has not been reached. There was a fear a few years ago that companies wouldn't be able to actually launch share plans into the EU, or vice versa, because of prospectus rules. For employees, at least, this has all been ironed out because there's been a prospectus regulation which has been implemented into UK law as well, where there's a really nice employee share plan exemption. So most companies are going to still be able to rely on that whether you're going into the EU or back over to the UK. So we can still launch share plans into the EU and vice versa. One of the areas where we're really interested about the whether there'll be a deal or no deal is on the impact on data transfers, because this absolutely critical area is still up for grabs at the moment. If we get a deal, we should be able to rely on the current regime, which allows us to transfer data over to the EU. But if we don't get a deal, we've got a real problem in the sense we're going to be treated as a third-party country. And in this area on data transfers, don't expect an equivalence decision anytime soon, despite the fact that we kind of got the same rules as, well, we have got the same rules as the EU. We've implemented the EU laws. We won't be granted that data protection equivalence because basically the EU is going to regard our security services as having far too much personal access to data. So we're not expecting equivalence decision very soon on that basis. This leads to a lot of issues as to how we can transfer data to the EU and to and fro the EU, especially EU to the UK. And in this regard, the law courts aren't being very helpful at all, because actually before, when we looked at what happened between the EU, including us and the USA, there was a reliance on a privacy shield that you could make, but that route has been struck down this year. So we're actually down to quite a few limited areas of ability to transfer data, and I think one has to make sure, especially in the share plan context, that actually you rely on binding corporate rules. But even then, the courts are a bit iffy as to whether you can do that. So actually, data transfer is a major area of concern at the moment. We think it's going to be doable, but actually, it's not a great. We're not in a great position on it. Another area that we're very worried about at the moment is on social security contributions. At the moment, we're all part of some social security regulations. If we crash out without a deal in 2 weeks' time, we'll be crashing out of those regulations. So actually, any double social security charges which you'd get if people were sort of moving from one country to the other, or working in two countries. All those exemptions are going to go. Believe it or not, we're sort of then left back with very arcane social security agreements that sort of last from years ago, 1970s or even 80s at best, where actually you have very different provisions, and not many of the EU have signed up to those as well. So actually, it's going to be a real mess on the social security side, and actually you can expect, if you're posting people to the EU, or if they are working in the EU part-time and partly over here, you can expect there to be some double social security charges, which is not great. Of course, the UK is being more amenable on this than the EU, but it's still going to cause a lot of consternation. The other thing that we are focusing on in terms of remuneration and Brexit generally is, of course, the ability to administer it. And of course, a lot of the administrators are sort of pulling back on their ability to administer particular types of share plans, especially sort of some of the UK ones, of course, are sort of putting out arrangements in Ireland in particular, where they have Irish approved share scheme arrangements. And maybe some of the underlying banks aren't going to be able to hold deposits anymore. So hopefully your administrators have all been in touch about this, but it is an area of concern that actually there's going to be limited background support, and we have to keep watching this area going forward. So actually, I just wanted to highlight in there some of the main difficulties. I could talk for ages on that, but our time is limited. So let's go to the next slide. Well, I've got a nice picture here. I wanted to talk a little bit about COVID and the impact, and of course, of remote working, which seems to be an absolutely hot topic at the moment. We know within Bakers, we're getting hundreds of queries on this, and actually doing webinars with hundreds and hundreds and hundreds of people turning up. And the idea, and I believe my neighbour was saying this to me the other day, well, I want to work abroad in a hotter climate for some months. But actually, this is going to lead to very, very many challenges, especially after Brexit, especially with they're moving over to the EU. So if we go to the next slide. Look, a lot of companies are taking different views on this. I'm not going to go through each of the ones, but you'll see some people are actually in favour of going for mobility and home working, and I would say, and then others are very reluctant to, because of all the tax risks and regulation risks. I think what we're seeing is a difference in sectors here. So I think I would think that financial services is actually going to be a bit more cautious than, let's say, internet companies on the IT companies on this. So, but I'll leave you there with the difference between what some tax directors are saying in terms of having much more greater flexibility. You'll see at one extreme, we're likely to embed a practice of long distance remote working, and like this is a real factor that we're seeing in high IT companies. But actually, on the other side, we're seeing people saying, "Oh gosh, I don't want to go to here because it's going to cause me too much regulation and tax risk." So I'll leave you with some of the statements of being on that. But clearly, at the moment, we're going through a major structural impact. COVID is bringing forward work practices that probably would have taken 10 years to emerge. The idea of people working from home, the idea of people that not having to work in an office in London. But you do have a huge array of issues to actually consider. Look, I'm not going to go through this slide in any detail at all, but I just wanted to put some a thought process there now. We can talk about this for hours, but let's go on to the next slide. look, some of the areas that I think one has to think about, especially in the context of Brexit, immigration, of course, like we're used to free movement going over to the EU. This is not going to be the case now. Yeah, we can go over for a business trip and attend a conference, but we're going to have to apply for visas otherwise if we're going to start working abroad. Regulation, like we can't just assume we can do whatever we like where. And I would have thought, of course, in the financial services sector in particular, one has to take particular care in that area. Employment law, if we're going through, if someone is going to work from a different jurisdiction, that employment, you have to think through the employment law implications from that jurisdiction. And of course, in a lot of the EU, they have much more restrictive employment law implications. And I mean, try stacking someone in France or something. So like there are a lot of implications to think through. Social security contributions. I mentioned before this idea that that actually we could be ending up in a regime if we crash out of the EU in 2 weeks' time. We could be ending up with a regime where actually companies will have to pay twice for the social security contributions of particular workers who are sort of posted abroad. So it is quite worrying that. Income tax withholding and employee tax liabilities. I think when COVID first came, there were probably a lot of organizations getting a lot of little queries going like, do you mind if I go and work in Brussels, or do you mind if I go and work in Monaco or wherever for a short period of time? And of course, the tax authorities at that point were sort of responding on an emergency basis with the OECD. But we're getting into 2021 now, and actually we're getting into a much different era where there's actually, this is all coming a little bit, I hate that word new normal, but I will use it for time's sake today. And actually, if people are starting to be there more permanently, you can expect local jurisdictions to want to impose tax on the employees. They're no longer in their jurisdiction for less than 180 days, which might be get them exempt under tax treaties. And then if they've got income tax liabilities, does that mean you have a presence as an employer, which will then impose withholding obligations? Which actually then gets them onto another thing, of course. If you post people over different jurisdictions, you're going to might set it your own presence up there for corporation tax purposes. So you might set up a permanent establishment and start getting corporation tax bills for the activities of people in those jurisdictions. As I said before, we're getting lots of queries about this and lots of initiatives, and we've even got an app in McKenzie that can help go through some of the issues that have come through. But I just wanted to focus really within the context of Brexit here, and just think, well, actually, in an era where people are wanting to move more, by coming out of Europe, we're actually putting ourselves into a more restrictive regime, and particularly on the immigration side there. At that stage, I'm going to stop, and I hope we're going to get a lot of questions.
Well, thank you very much for that, Mark and Jeremy. I'm afraid time for questions is a bit limited because we've overrun by about 10 minutes, but we can pick up a few of them. Folks, please do feel free to input your questions. I will make sure anything that's typed does get over to Mark and Jeremy with your email, and they can get back to you directly. But just to get things cracking, Mark, you mentioned briefly that equivalence had been withdrawn from Switzerland. Are there any lessons we can learn from that?
Yeah, I think the lesson I would draw from it, Michael, is that it doesn't matter how equivalent your laws actually are objectively. They won't give it to you anyway if they don't want to for political reasons. And I think the Treasury's obviously come to that view, the government, in terms of prioritising divergence, because I think in reality, if you stay closely aligned with their rules, that is no guarantee that you will get the equivalence decision that you want. As part of the negotiations, we've seen the UK has submitted, I think, 2,500 pages of questionnaires about its regime, despite having an identical regime today to the EU. So that would be my steer, really.
Okay. Mila Sullivan brings up, I think, an interesting sector that falls very much, Jeremy, into what you were looking at, which is venture capital. Would you be able to compare sort of the UK versus the EU post-Brexit in the venture capital arena?
Yeah, I mean, actually, I might just pick up on another area where we're seeing, in relation to venture capital, where we're seeing in the EU an encouragement of employee participation in venture capital and in private companies generally. What we're seeing in the UK is a slightly sort of rabid reaction by the Office of Tax Simplification, who are coming up with a report which is trying to equalise capital gains tax and employment income, or strike down particular areas of maybe of share ownership, whether it be growth shares or other rights that are often given to executives, perhaps even in the venture capital industry, which is actually leading to an increase in taxation. So the message we're giving out in relation to venture capitalism and employee share ownership in private companies is terrible at a time when really we want to be giving a nice image of we're going to be a good place to do business. Now, the OTS report is probably, it's not government policy, but they're definitely putting things out there. And add to that things like other people coming up with wealth tax ideas. It doesn't automatically look like a great place for people to be based.
Yeah. This one might be for you, Mark. It's from Anita Millar on the issues of ESG disclosures. Isn't the similarity of the eventual UK versus EU regime difficult to forecast? The EU taxonomy might be too prescriptive and drive solutions that might be overtaken by new tech. There's also move to harmonization within IFRS, looking to create a common regime. And Asia, of course, is beginning to wake up to this. Any quick thoughts on that about disclosure?
Yeah, I agree with that comment. I mean, the UK is going to have a similar regime in terms of structure on day one, but as you say, the taxonomy may be different. I think the government's been clear that they will consider the domestic needs of the market in developing the UK taxonomy, so it could well be different. The disclosure regime, could be different in the UK, I suspect, ultimately, moving forward. And I think with this whole thing, it's a classic area where there'd clearly be benefit in global harmonisation around an agreed set of standards. But the global standards that do exist are relatively high level, and so what you're seeing is each regulatory system going off in its own direction, and you're going to end up probably with quite different rules, which is not great.
Peter Jan Brakeman is curious: will UK banks retain market access in the EU under the equivalence framework for third countries? And will that cover MiFIDs? You've mentioned CRD, of course, and PSD. And will this access differ with regard to investment or retail banking?
Yeah, I think the answer to that is it's different depending on which tower you're talking about. There's a number of them mentioned there, right? So MiFID has an equivalence regime which can be switched on relatively easily by the Commission. PSD2 does not have such a regime. The CRD does not have such a regime either. And in relation to insurance, it's also quite limited. There's some equivalence for reinsurance, but not lots of insurance. So it's pretty patchwork, even if it's switched on. And I think what we've seen over the last 2 or 3 years has been the EU regulators taking an increasingly aggressive stance about the ability of customers to sort of come to the UK on a reverse solicitation basis. The EBA did put something quite out last week about bank accounts, existing bank accounts that retail customers may have. For example, saying that there's no need in its view under EU law for that to be shut out, but it sort of becomes a domestic, country by country issue. But my sense is that sort of it's going to be more difficult with retail, whatever, even under a good outcome on equivalence, it'll be more difficult with retail, and it will be more difficult in some areas than other areas.
Okay. In the time available, I really can only take just this final question, but it's one that I think applies to both of you. And Jeremy, I might direct this to you first, and then Mark, perhaps any subsequent comments you'd like to make. It's from Professor Tim Connell, and he is curious if both of you could speculate on what will happen to employment in the city of London post-Brexit, both for existing staff and future procurement. I must say, personally, looking at this, it looks like a terrible mess where my HR department will be fighting for me to be retaining talent, and my compliance, taxation, and bureaucracy hats on. I want to stay away from this. So it seems like a heck of a mess ahead. Jeremy, your thoughts?
Yeah, I think my long-term worry is it might be a slow drip feed away from the city. I think it might not be sort of thousands of job losses from day one, but I think it might be that opportunities will start to go elsewhere in terms of outward investments, especially from the Far East, China, Japan, and the like. I think my worry would be that actually people will be looking at the wider EU market, seeing that actually isn't it better to be in the EU, and actually a lot of those outward investments might go into the EU rather than London. Though I think it's always fair to say that London does have the advantage in terms of scalability, and actually, if you want to be here as part of that London package, I think we shouldn't underestimate our strength of that and our technological architecture here. So it's not all gloom and doom, and our fintech area is quite advanced. But Mark, you can come in on that.
Mark,
I'd agree with that. I think it's the sort of drift. But I'm sort of fairly bullish, actually, probably compared to some people, because I think when you look at the job numbers that have moved, they've been quite small so far, sort of under 10,000, much less than predicted. That's going to, increase over time. But also the fintech sector's added, 20, 30,000 jobs, right, in London the last 5 years or so. So, there are replacement jobs, and banking anyway is undergoing transformation in terms of, sort of more automation and so forth. And the other thing is the aggregation point Jeremy made about London. It's sort of in the top 2 financial centres in Europe. The next biggest one after London is Zurich, and the next biggest one is Edinburgh. So none of those are in the European Union. And unless the EU can really sort of aggregate around a single centre, I think they're going to still face that sort of balkanisation challenge. And it's going to be hard for them to compete, I think, unless they can do that. So I'm relatively optimistic, but there are challenges, of course, Brexit.
Well, thank you both very, very much for this. I'm afraid we have run over time a little bit. Just a quick close, if I might, if I could give really 3 rounds of thanks. I mean, firstly, to the ESOP Center for all the organization. Do remember that there are a variety of resources on the ESOP Center which are tracking the issues that Mark and Jeremy are raising. We have a monthly newspad, and there are, in fact, weekly bulletins that you can subscribe to if you wish. Go to the website and check those out. Another round of thanks again to our sponsors for their kindness, generosity, and tolerance, especially as we've been talking about Brexit for 4.5 years since the referendum, and quite a bit before that. So this is the final Brexit before Brexit, the real Brexit that we're going to host. So, but we will be opening, in fact, next year with a session very much on the future of Brexit, charting a new chapter on things. And I would encourage you to look at that, because we're going to have Leslie Batcher there from the Institute of Export kicking things off. All the events that are forthcoming are clearly on the website. But I'd like to thank you, the audience, for being here today and for feeding in your questions, which were very, very helpful. Finally, if I might, gentlemen, I'd like to thank you, both of you, for going out on a limb. I think it would have been very easy to say, well, we'll just wait, we'll do this in January, Michael. But I appreciate the timeliness of it, and I appreciate the preparation that you put into it and the comments that you made. And I certainly am going to be watching this with interest. Unfortunately, due to COVID-19 and working from home, I'm unable to open the floodgates of applause, but I have brought my Korean karmic clapper, which is definitely from outside the EU, and I will thank you on behalf of the audience. And I suspect we'll be having both of you back to be discussing this as it evolves, because Brexit is definitely the Christmas gift that keeps on giving.
Thank you very much for having us.